Happy Friday, everybody. How's it going out there? Hope you guys had a good week. Hope you had a good non-farm payroll. Yes? Nah, it sucked. Well, let's see what we can do to make it better. My name is Andrei Knight. This is Fibonacci Fridays. Thank you all for joining me. It certainly was a lesson in staying flexible. And in following the cues and the reversals that the market throws at you. But we'll go through it, Mr. C. I'll show you how I did it. We'll talk through some of the potential pitfalls along the way. Maybe one of them was what it's ensnared you. Maybe not. We'll find out. And on some of these pairs, there was a trade. And on some of these, there wasn't. I'll show you, hopefully, how to tell the difference between them. News trade or long-term fib, Mr. Boyke? What would be the most helpful? Long-term? Okie doke. I will do my best to squeeze that in near the end. All right, let's get into it. It's called taking a breath, Boyke. I have to talk for there to be sound, Manoj. If you guys are that jumpy, I can see why NFP messed you up. You know why I made some money on non-farm payrolls? Because I didn't get in until almost 2 hours until after non-farm payrolls, even on a 5-minute chart. Exactly, Himashu. Let me guess, Mr. C, you got stopped out on this reversal, right? This pullback snagged you. Yep. You've been to my classes before, Mr. C. Remember how I always, even if it runs 1,000 pips, I always advocate stay out of the first wave, wait to catch at least the second. Remember that part, my friend? Today you got to experience why. I mean, I'm not laughing at you, please. You know, I'm always happy when people make money. I'm always sad when they lose it or have a frustrating experience. But I don't make these rules to torment you guys, so you watch price move and feel terrible about it. I make up these rules. I actually don't make them up. I realize them through hundreds and hundreds of trades, you know, because it's the safer way to do it. And it's exactly right. It's like catching a falling knife. Who wants to do that? So let's go through this step by step. For those that have never been to one of my webinars before, the way that I trade news is very similar to how I trade long-term fibs. And you'll see an example of a long-term fib when I go over the S&P with Boykin. For the shorter term ones, the first thing we need to do is qualify that there is indeed a news trade. Because normally I'm not down here on the 5-minute chart. Normally I trade the 1 hour, 4 hour chart. Okay, and the way we do that is I take the two most recent highs and I connect them. Okay, and notice I'm going by the bodies, you guys, not the wicks. Okay, because as Mr. C unfortunately found out, wicks represent prices that were tried but rejected by the markets. Okay, I need the bodies. The bodies represent consensus. It's the close. It's where buyer and seller met and a transaction took place. Okay, so same thing across the bottoms, the two most recent ones, going by the bodies, not the wicks. First thing you'll notice here, well, gee, this guy's widening. I don't like widening, simply because the longer it goes, the bigger it gets. I like either parallel or closing like a triangle, so my options get limited. Right, and eventually I run out of space. So all I'm going to do, you notice what I did was I tipped it up. I ignored the second to the last highest point, and I just did a horizontal line across the highest point. Usually you can do that with the highest or lowest ones to end up with something either parallel or shrinking, but overall the idea is I'm identifying the pre-news situation. You see what I mean? These were my most recent lows. This is my most recent high. Overall, this kind of represents the range that we were trading in before the news number came out. Here, for example, if I were to do it earlier, we would be in a slightly upward trending channel. Now we're more or less horizontal with the bottom creeping up a little bit. So it's a really, really elongated triangle. This represents what was happening pre-news. And the reason we get into the 5-minute chart is because I always give it 5 minutes. That's just been my experience. I've observed it on a couple different time frames. But 5 minutes seems to do the trick. It lets me see the initial reaction and how it settles, Mr. C. Okay, and sometimes you have it that this thing will go 100 pips, and I know the faster it goes, the further it goes, the more tempting it becomes. You start thinking it's never going to go back, and you're going to miss the move because it's going to run away without you. I've been there, Mr. C. All the advice I give you, all the rules I trade with, come from the school of hard knocks. Okay, so if I chuckle a little bit because you got caught by the falling knife, it's because I've been there, I know what it's like, and I can relate. Okay, I'm laughing with you in every sense of the word. Okay? I've learned, and that's why I do the 5-minute chart. That's why I even have a countdown timer. on my 5-minute chart because I will do nothing. If it goes 50 pips, if it goes 100 pips, if it goes 1,000 pips, I will do nothing till this counter gets to 0 and I get a new candle. Okay, well, that's good. So you did wait out the first 5 minutes. Excellent. That's a good start. So you did hold the entry. You got snagged by the exit. Okay. So my first test, it doesn't matter the length of the wick, you guys. Sometimes it goes a short distance, sometimes it goes a long distance. I go by where the body is. As you've noticed, I'm fond of the candle bodies. If we close outside of the pre-news trend line, I have a trade, and I stay on the 5-minute chart. Regardless of how long the wick is, if we come back and I close inside the pre-news trend lines, I have no news trade. Now, it does not matter how long we went, long or short. Okay, that doesn't give me any expectations really of what's going to come. Well, it's a really long wick. It's likely to go far. Wow, it's a really long pullback. Maybe people aren't as bullish. Maybe it was a short-term reaction. I try to keep those kind of expectations out of my head. Okay? I look at just the body. And what I can tell from this already, you guys, we didn't even get that far into the analysis yet. We were in a tight up channel. Right before news, we went into a slightly wider horizontal channel. News helped us close bullish. That's what I can derive so far. Okay, it changed the situation to the bullish side. If we were to close between the pre-news trend lines, keep in mind, it does not mean I'm forbidden from trading this pair the rest of the day. No such rule. I just go back to my 1-hour, 4-hour charts, now with the satisfaction of knowing that news is either over or wasn't enough of an impact to mess up my longer-term trade. That's the only conclusion I draw. But if I change what was happening pre-news, it's worth sticking on this 5-minute chart a little while longer. That's the only question I'm really looking to answer. So next, let's draw our fib. Okay, and for those that haven't been here before, basically I measure the extent of the reaction to the news. I start my fib, what I call point A. There we go, point A. Basically at the lowest point, but you might be going, wait a minute, that's the lowest point. But that was before news. I'm measuring the reaction to the news. Okay? So in this case, I start here. Now, this was one candle. It can certainly be more than one candle. As many as it takes to get a pullback, a significant pullback, and or a red candle, or a candle of the opposite color, I should say. Whether it's 1 or 10, I don't care. In this case, it happens to be 1. But just don't always, trace the first candle and call it done. If we were to make a higher high, we don't yet have our highest high. Make sense? So that's point B. And I have the extent of the reaction to the news. If this was a longer term fib, the only thing I would do differently is I would obviously include this. But in this case, I'm measuring the reaction to the news. I saw one on the pound this morning when we had the, what was it, the manufacturing PMI earlier on this morning. There was actually a gap. Well, there's a small gap here too. But the thing is, the wick closed it. Sometimes there's a gap with no wick. In that situation, you guys, I would take my A from here, the close of the prior candle. Because again, I'm measuring the reaction to the news, right? Which includes any gap it might leave. In this case, there was a gap, but the wick covered it. Something else you'll notice, now I'm going wick to wick. You guys might be thinking, Dre, I can't keep up. You were just saying connect the bodies. For trend lines, yes, I want consensus. For support, resistance, breaks or bounces above or below, all those kinds of things, I'm after consensus. Okay? Yeah, Daniel, you're kind of seeing where I'm going with this. But when I'm doing fibs, I'm measuring distance. So there you go, wick to wick, furthest point to furthest point. Makes sense? If you're ever wondering whether to use bodies or widths, ask yourself the question, am I trying to find consensus or am I trying to measure distance? If it's distance, you go wick to wick. Consensus, go by the bodies. So I grab my Fibonacci tool. I go down to the bottom of the wick by point A. And I drag all the way up to point B, not letting go of the mouse, and I let go at the wick by point B. So there's my first fib. Okay, you should already be looking at this, noticing where we had our reversal points, and you'll see a better fib in a moment. And you should already be going, oh, market moves aren't really random, are they? Even during something wild and chaotic like non-farm payrolls, there's still a pattern. Okay, so now let's get into your trade, Mr. C. You had the right idea, okay? You waited out the first candle, right? We had a pullback. The pullback closed as a near doji, which I treat near dojis the same as perfect dojis. Does not matter. I just draw an imaginary center line through the body. Okay? And we are above that center line. So we have an extension. We have a pullback. The pullback closes as a doji. And you have a bullish open relative to that doji. Okay? So I can totally see the logic behind your trade now, Mr. C. But one fatal flaw. And that's okay. That's good because this is how we learn and hone our skills. What's the flaw? Anyone see it? There is one clue here that this thing's not going to go, even without any other indicators on the chart to confirm the fibs. I'll give you a hint. What's our C? What's our pullback? You got it, Mr. C. Unfortunately, even though you are bullish relative to the prior candle, you are bearish relative to resistance. 2 candles in a row, you closed under resistance. You know, where's your C? You didn't quite make it to 78. You failed to break 61. So what you basically did is you're bullish relative to the prior candle, yeah. And this can happen particularly during fast-moving news. You got stuck in tunnel vision. You failed to widen your perception to include the context. It's not just about the open relative to the prior candle. Okay? Contextually, and there's your other problem. Never, ever go down to the 1 minute unless you're trying to find your exact time differential for setting your pivot point start hour. That's the only thing the 1 hour is really good for. It's not good for trading, especially during news. You don't need finer resolution during news. What you actually need to do is zoom out, see past the noise, and see the prevailing trend. Look at your hourly. Are we bullish or bearish? On my hourly, there's no question. You see what I mean? On my 30-minute, this little question. Actually, when you guys catch yourself squinting at your chart trying to find out what to do next, you do not need to go lower to see quote-unquote clearer. You see clearer on the higher time frames, not on the lower ones. On the lower ones, you get more noise to confuse you further. And especially during news. Once again, first hard rule is never go below the 5 minute. Never act during the first 5 minutes. Wait for a new candle to open. So yeah, that was the problem. You don't really have a C. As a matter of fact, what you think is your C is actually your resistance, and you're failing to break it. You have a bullish open relative to the candle, but a bearish open relative to resistance, relative to the overall context. So hitting resistance here with the wick, opening here with your body, implies a downside reversal. Don't buy just before a downside reversal. It's subtle. I mean, literally a matter of a pip, right? Or a pixel. Ah, thank you, Pipper. Just experience. You know, I've seen a few hundreds of these. I've paid my dues in losing trades. I'm hoping to spare you guys the pain. That subtle difference is the big key. This tells me we're going down. Don't buy if we're going down. So that's the first part. Second part is what we did. And remember, our point C can be either a body or a wick. It's just the furthest point reached. What have we got here? A retracement beyond 100%. Well, you can't have a retracement beyond 100%. That's called a reversal, not a retracement. So we flip our fib. And that's what I said. Today was an excellent teacher, an excellent lesson in following the markets. So I flip my fib around, and guess what? I lose my snaps. So my first clue is, this fib isn't as good as the other one. And what I mean by a snap, by the way, is reactions to the in-between levels, either bodies or wicks. Okay? We got one a little bit later on, finally, because it took the markets, 1, 2, 3, 15 minutes to realize what I saw, that it's reversing. So we start out with no snaps. Eventually we get a snap. This is validation that you've got the right fib, that other people are reacting to the same levels you're watching. So I flip my fib around. Obviously now, this is my B. This is my A. That's where I started. And I'm waiting, watching for a C. This is good. We have a break. Retest as support. We go further, we go further, we go further. 94.2. I don't have a C to D rule for 94.2. Okay, so I can't trade in the short direction. That fib just became invalidated, and I continue watching. Notice I'm not eager to jump into a trade. I watch as long as it takes till I have something good. And now I notice I'm zigzagging in this direction. And so I flip my fib around again. As many times as it takes, as many candles as it takes, you guys. I don't have a rule that says you must enter after 6 candles. Okay. Now, a couple cool things I can explain here. Okay, I flip my fib around yet again, back now to the upside. And again, I'm following the markets. I don't have any expectation. I do what price tells me to do, even if it means reversing your fib twice. First question that comes up, why is my A on the second wick, not on the lower of the two, which is the first wick? Anyone know? Down move, start of move. Close, you got. Start of move kind of has something to do with it, yeah. I like to take the most recent low to the most recent high, even if it's not necessarily the lowest low or the highest high, right? 2 wicks here, I start with the most recent one. 2 wicks here, I start with the most recent one. The fact that it's a wick means we had a pullback in between. And then I check for snaps here again. Next thing to do is check for snaps. And what I notice with this one, look at that wick. It smacks right down to the 50%. You see, Daniel was 1 step ahead of me. He saw this already. And I mean, it touches it to the pip and bounces right off. That cannot be coincidence. Notice also, oh boy, like I said, today was a good teacher. Notice we have no snaps until that point. Remember how I had the downside fib and it took me a while to realize, oh, I need to change back to the upside? It probably took the other market participants a while too. They didn't realize there was a zigzag till after this bend. Then it started looking a little more like the letter N or the zigzag pattern that tips us off that it's Fibonacci time. Okay? When you get the snap is when the rest of the market noticed. So it took them a while. Took them until this bend. Now it's very easy to try multiple fibs and multiple variations. Okay? If you're in MetaTrader, this red dotted line in the background reminds you which 2 points you connected to draw your fib. Double click on it, and you get these little white squares at each end. These are movement handles. Now simply click and drag, try the other A. It's a lower low, but look what happens. It moves this down, so I lose that tight little snap. So I always start with the most recent. And if I don't see good snaps, I try out nearby levels until I do see good snaps. Try the nearby A's or the nearby B's. Usually it'll be the most recent to the most recent. As the second backup choice, go to the lowest to the highest. But you'll see it. That's why I call these things snaps, because suddenly everything snaps into place. And Anant, it doesn't matter how late it comes. Just like it doesn't matter how long it takes to form your B. It's not always at the end of the first candle. You wait till you have a bend, till you have a reversal. You've got the right idea, Nathan. You don't want to buy at the very top. Right? That would be like shopping for a house and saying, this is a really swell house, but why are you only asking $1.5 million for it? Let me give you $2 million. I'm in a good mood. We don't do that when we're shopping, so don't do it when you're trading. So you've got the right idea. You wait for a pullback. Okay? To get the better deal. Buy it while it's on sale, but add another condition to it. A pullback that finds support and then reverses. Just to be sure that you're done with the pullback and not get caught in one of these knife falling situations. In this case, let me show you the entry, okay? And this will make sense. Point C is how far you pulled back towards A. Okay, 50% in this case. If I move my mouse over, yeah, that's roughly halfway between A and B. Okay, so C is the extent of your pullback. Your entry, however, is not at C. C determines D, which is your target. Fibonacci basically is whether you're trading short-term news or long-term situations. Fibonacci is basically measure A to B, sit back and observe where C is. Based on C, you trade to D. Okay? That's Fibonacci in a nutshell. Measure A to B, observe C, trade C to D. But C is not your entry. Okay, and this ties back into your question, Nathan. And counterintuitive, by the way, is the only way to make money. If you do what everybody else does, well, 95% of traders lose. We know that statistic. So counterintuitive, counter-crowd is really the only way to consistently make money. You might get lucky otherwise, here and there, but we're after repeatability and consistency. So you got the right idea. Wait for a pullback. Buy when it's on sale. But you also have to know when to buy. Timing's important. Wait till you find support. Right? I have a reversal candle here because it goes the other way and it closes the opposite color. But here's the kicker. I open the next candle bullish to that reversal candle. I don't know that this is going to be a reversal candle till it closes. While it's open, it could go up, down, red, green. Right? It's when it closes green and the next candle opens bullish relative to it that I know I've got a reversal on my hands. You see what I mean? This is C. This is my entry. The nature of a reversal is you don't know it happened till after it happened. Wait for the bend. Wait for the close. Wait for the next open so you have confirmation. In other words, don't be impatient and jump the gun. Now hold on a minute, you might say. Aren't you, even though it's a bullish open, aren't you jumping in under resistance? Wasn't that the fatal flaw here? Two slight differences, you guys. In this case, my C is under me. And it has a good snap. We didn't have that here. The only reason I didn't want to jump here is because I was under my C. The wick hadn't completed the move to the 78. And the 61 was right over my head. Here I completed a move. I have a bounce. I have my C. I am pushing up and away from it. Well, don't I have to worry about this 38? No, I don't really have to worry about every fib along the way. I really only care about my C, my D, and in some cases my 0, my B. I don't have to worry about every level in between. They're just support resistance. They might be opportunities to add to my trade or to trail my stop when I have a break retest from the other side, for example. But they are not showstoppers. A. B, I have a candle just 5 minutes ago that clearly ignored this 38. It was neither support or resistance. So I don't have to worry about it being resistance now. In this case, all I had to go on was a wick. And remember, a wick represents what was tried and rejected. So I didn't have any confirmation, really, that I could break those higher levels while I was under them. Here I have a C that I pushed off of, a candle that closed as a reversal candle, and a candle before that that clearly shows this level is not going to hold. Okay? So very, very subtle, but very, very different from what we encountered back here. So this is your C. This is your entry. Not at C, but sometime after C. And by the way, next week on Wednesday, I'll do another institutional trading strategies webinar where I talk about some of the indicators that I use together with Fibs to confirm and clarify their signal. Here I'm going based on pure price action. It's news. Indicators aren't much good right after news. Why? Because you just have something that was much longer than everything that preceded it. And indicators are generally based on averaging data in some way. Okay, this is going to throw off your average, your formula. Okay, but using some indicators together with Fibs, you can sometimes get your entry closer to C. Though one candle later is about as close as it gets if you, like me, like to trade only on candle open. Okay, but longer term time frames, it might be a couple candles after C. Okay? So Wednesday we'll go over that. What you can use together with Fibs to fine-tune their signals. Sometimes maybe get your entry a little closer to C, but it'll still be after C, not on C. That's just the nature of reversals. They have to happen in order for you to see them. Okay, so let's talk about D for a moment. Targets. For me, it doesn't have to take out the high, though it can be an additional conditional test, I suppose, Nathan. But then you're trading mid-candle. I find the open relative to the close before to be a pretty reliable indicator, especially when you combine it with something like a MACD or a stochastics to confirm the direction. Could entry be on the break of the red candle high? Way up here? You mean, Igor? Or which red candle? Or this red candle, you mean? The one marked with a C? It could be, but it's a little late. Here again, it's extra insurance, but insurance is never free, is it? Right? Insurance carries a premium. I think I have enough information here. But I'm not going to say what you're doing is wrong. You know, there's a more aggressive way to trade. There's a more conservative way to trade. Both are correct. There it comes down to more mindset. Pick the one that's right for you. Okay? This is a bullish open after a bounce and a pullback. For me, that's enough. If I was missing either of these, I might also wait longer for additional confirmation. It's just that the pieces kind of fell together into place, one after another like dominoes. The red candle before a possible C? It was. Yes, Tim, you're absolutely correct. The problem is we fell further after that. So here again, and here this was a bearish open. You see that? Bearish open, bearish open. What saved me, and this is why I wait for candle open, there was no clear entry. And then suddenly we fell further and had a new C. The deepest, most recent one is the correct one. Every pattern is good till it is replaced by another more recent pattern. Well, based on this chart, yes, Nathan. 2 support levels away. Oh, you're referring to this one. Could be, potentially. Pull the trigger here. Actually, it brings me to Nathan's point about stops. Stops, I like 2 support levels away plus some padding. And, you know, usually I'd have some pivot points, moving averages, other things on my chart. So here it looks a little far, but it's really not far, you guys. It's 6 friggin' pips. Don't forget it's the 5-minute chart. But usually there'd be a moving average or something else on here. 2 support levels between my entry and my stop. So yeah, in the case of this entry, stop would go here. And not right on the line. Always give yourself padding. Stops go a little wide. Targets go a little shy. Don't forget this rule. It's the difference between winning and losing. If you see an obvious level, the bank traders that are after your money also are aware of that level. Do not doubt. Stops a little wider. Targets a little below what you expect. Okay? So in the case of this entry, Tim, following that rule, it's still 2 support levels away. Stop goes here. You would still be in this trade. It's a pullback. It's nasty and it's scary, but it would not have stopped you out. So yeah, you could enter here. Absolutely. And as a matter of fact, taking a little bit of padding away from your target, this one would have actually gone to target. Mine, and we'll get to this in a moment, was also a lesson in knowing when to exit early, ahead of your target. Yours, if you follow the rule of stops a little wide, targets a little shy, would have actually gone on the target. And Manuel, I think your question is similar to the one Tim just asked. There was, and based on our stop rules, you would still be in. Let's talk about targets. The 3 most common retracements you will encounter are these guys right here, 38, 50, and 61. There can be obviously other pullbacks, and I have movement rules for most of them. I don't have one for the 14.6. I don't have one for the 94.2 because I haven't observed something with enough statistical repeatability. Okay, so those are just support resistance levels, FYIs, if you will. But for most of the others, I have C to D movement rules. I'm not going to bother going over all of them right now, but here's a link. You'll find a PDF document attached to the first post. It goes through all of the C to D movement rules. It also shows you how to set up your fibs so they look exactly like mine. Because you'll notice what I'm doing is I'm showing the retracement levels and the extension levels. That's why all of these are greater than 100. Okay? I show them simultaneously with one tool. versus normally it would be two separate tools. That's the only thing I do different, and that document will show you step by step how to make that modification. Just a little bit of a time saver. But for the three most common ones, the ones you'll see the most often, and the ones I want you to start out trading, if your C is at 38, more often than not, your D will go to 138. If your C is at 50, your D, more often than not, will go to 161. And if your pullback, your C goes to 61, your D also goes to 161. Pretty easy to remember. That's why I say start out with those. You don't have to get bogged down on technique. You can focus on watching price action. And they're the most common ones to occur. Okay, so based on this C, our target would actually be up here, 34.56. Okay, in other words, this trade is not done yet. It's still in progress. There's still room to go, and I'm actually reassured by the fact that we just broke resistance and opened right on top of it as support. That's a good continuation signal. But being that it's news, you know, I don't like getting caught in these. So let's talk about tip-offs to take profit ahead of target. Remember how this configuration looked under resistance? Look at that. And well, you might say, well, this opened bullish and it made a higher high. Okay, then get out here, because now you have a reversal candle and it opened bearish under resistance. Either one of these is a good take profit signal. And after that drop, we chop, we chop, we chop, we chop. I was busy talking and teaching a class. But zero, remember I said 3 points matter. Your C retracement, your zero, and your D target. I will re-enter a trade if we break zero and find support at it or above. So either of these bullish opens would be a good re-entry point. And now the target, based on our C, again, is 161.3560, a little bit below. Set your stops wide, set your targets shy, unless I find resistance and turn around at the prior high, in which case I again take an earlier profit here. So you see one news item, two reversals, and two separate trades. And that's how you use Fibonacci in a nutshell. Again, next Wednesday, we'll talk about some indicators you can combine with this to fine-tune its signals. Real quick, FX admin, just give me a couple minutes real quick. I want to show you an example of a long-term analysis. And Boyke has promised I'll do it on the S&P. Now that we know the basics of how to do this, you know, let's apply it to something else. And I'll show you time frame doesn't matter. Instrument doesn't matter. Let's do a long-term analysis, see if we can't figure out what this S&P is up to. And once again, what I'm doing, I'm looking for the pullbacks, right? A good way to start out drawing fibs is to find the space in between. I'm looking for pullbacks. I'm looking for the bend right before that to find my A's and B's. Anant, very close. Your prior question, we wait for a bullish open or an open in the direction we want to trade. So I didn't get many snaps there. I'm going to the next major bend that catches my eye. Bingo. I got some snaps. So let's use this as a working model. Boyke, what we had here was a 38 to 138 move initially. It overshot its target, but it failed to find support. So this first time, we don't activate the bonus round. The second time, we got the bonus round to the 161. But we didn't have a retested support at the 138, so this never triggered as an entry. This move, third attempt, second bonus round attempt, this is your 138 to 161 bonus round extension. Okay, we did find support at the 161, technically setting us up for a 200% bonus round. Now, I'm not looking at my other indicators, but I'm betting this higher high on your OSMA or your MACD, I'm betting this would have formed a divergence. So maybe you got in to go long, but here doji bearish open, probably with a divergence, would have been your early take profit signal. Okay? You go back through the bonus rounds the same way you go up. In this case, remember, our C was 38. This doesn't count. This was before we had our B. Neither of these made it to 50, so our C is 38. I'm getting there, Boyke. Stay with me. Okay? Originally, our D was 138. Bonus round was 138 to 161. We go back in the same order. You retrace your bonus rounds till you get to D. Once you break D and retest it from the other side, in this case as resistance, your next target is either 0, returning to 0, that all-important 0 point, which was your starting point for the Fib. That's why it's the ending point. After D, not after a bonus round. After you break and retest your original D, you go to either 0 or your 21 exponential moving average, which, let me throw that on there real quick. 21 exponential applied to the close, just to make sure we're not hitting that first. No, we've already broken that. So I would say what's going to happen next, Boyke, you notice we're retracing up off of our lows. We're going to retest 1950-40 as resistance. If it holds, then you get in, you target 1898.25, and again, a few pips above it, right? Never on the line, just for safety. So first retest 1950-40 as resistance, and then very likely a drop to 1898.25. So you see, you guys, we did the same thing that we did on a 5-minute chart in reaction to news, now on a daily chart to analyze a multi-day move. And by the way, watch this. I'm not going to move my Fibs. Here it is on an hourly chart. Pretty useful. Here we have support. Once we break it, we come up, we retest it as resistance. Again, I'm not moving my Fib. Here it is on a 5-minute chart giving me perfect snaps, in this case with a body. Look at here, this ledge we had. And then as soon as we break it, we come up, retest as resistance. Fibs are time frame independent. They are instrument independent, which is why I love them so much. Alrighty, you guys, here's a couple links for you. Hopefully I got your attention. If you'd like to go further, first link is a daily newspaper, electronic newspaper that I publish, or rather a robot publishes for me. It scans all the financial headlines out there on the internet and basically sorts them by which ones get the most clicks or reads. And this is what I do while I do my morning analysis and have my morning coffee. I look at what other traders have on their minds. And then I look at those charts and scenarios as a starting point. Totally free. You guys, you can visit that link every morning. You can register with your Twitter or your email address to have it sent to you. Okay, just my gift to you for stopping by and enjoying the webinar. Here's my Twitter and my Facebook account, if you'd like to follow me there. Now, obviously, I've only covered one indicator and one type of strategy today. There's much more to it, but hey, I only get an hour with you. We'll cover a little bit more next Wednesday. Please join me for institutional trading strategies, but it's again an hour. I do the best I can, but believe me, it's not everything I've learned over years and years of failures and successes. It's the bare essentials. If you want the whole enchilada, the good news is I've recorded some of my best workshops. Okay, this is about 5.5 hours of material. You can watch it over the weekend, and you can be trading better by Monday. How cool is that? And I cover not just Fibs and other indicators. I cover several different kinds of scenarios and entries. I cover trading psychology, money management, risk reward, the rules of probability, all sorts of stuff you just don't get with other systems. It's not that my candles or indicators are any redder or any greener than anybody else's. Okay, people always ask, what's the best indicator to use? Coloring it purple doesn't make it work better. Okay, in the end, it's not about the indicators. It's about all this other stuff that trading systems usually leave out. Okay, so as complete and as thorough as I could make it, you guys, recorded for your convenience so you can watch it at any time. Second link, if you found today useful, well, I got great news, you guys. We do this twice a day, every day. 10 times a week, 40 times a month. We look at trade setups in the morning. We come back in the afternoon and discuss which ones worked out and which ones didn't and how we can modify our strategy to do even better in the future. Imagine what that would do for your trading results. And the good news is it doesn't cost you more than 1 or 2 losing trades for a whole month of coaching. Not just training. That's what videos are for. Coaching. Letting you trade, watching you, and fine-tuning your results. Plus, you get one of the biggest video libraries on the internet, just as a bonus. So it's a combination of watching videos on your own, applying what you've learned, and then, hand-on-hand mentoring. If you're torn between the workshop and the live coaching, hey, don't worry. If you get the workshop, you'll get a discount on the live training, so you earn the money you spent on the workshop back. How cool is that? If you sign up right away for the live training, we'll throw in the workshop for free because I want you to hit the ground running. I'm not going to withhold information. Ultimately, my goal is your success. So I want to arm you with the tools necessary. Okay, so you can do it in either order. It just depends, hey, I love this guy. I'm all in. I want to train with him every day. Great. We'll see you in the live room. I'm not so sure. I want to watch a little bit more of his material. Great. Get the workshop first. It's a good way to test the water. Again, you'll get a discount on the live training if you do, so you'll earn this small investment back. And if you're tight on money or time, hey, we understand. We have the weekly video updates, which I kind of call my budget program. You don't get to interact. You don't get to ask questions. Hey, it's the budget program. But what you get is a recording of my Monday morning class. Why that one in particular? Because it's where I do my long-term setups for the week ahead on several different pairs. So at least you have some guidance in your own trading. Or maybe some people like to be more self-directed. They don't like other people interfering. In that case, the third option is for you. But guys, my goal is not to sell you something. Okay, my goal is to make you aware of the tools available to you to further your education. fxnight.com is actually all about a ton of free resources. The only things I really charge for are these, my time. Okay? Everything else on fxnight.com is free. There's a free forum, free chat room, free indicators for MetaTrader, free streaming news, tons of stuff. Just come check it out. And at the very minimum, please join my mailing list. I'm not going to spam you. I send out 1, maybe 2 mailings a month, if that. Usually it's to invite you to other free webinars like this one. So once again, you can further your education. Thank you very much. I'm Andrei Knight of fxnight.com. Hope this has been useful. Wish you guys a wonderful weekend and an even better trading week next week, hopefully. I'll see you Wednesday for institutional trading strategies.